Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Hello everyone, welcome back to Punch Card Investing. That was really difficult to figure out the logistics of making that music play. Jack does a good job of that. But this week we are talking, I guess this is a bit of a follow-up episode to one we did a couple of weeks ago looking at the ARK, one of the ARK ETFs, which I see there was some big news out of ARK this week. I'm not sure if you guys caught that. Maybe we'll talk about that later. But
the anti-ARK here.
Yeah, this week we're talking anti-ARK, which is basically Tobias Carlyle's two different deep value ETFs. So he's got one called, or one with ticker symbol ZIG, ZIG, as in Zig when others zag, hence the title of this particular stream. So that's one we'll go through. Essentially, it's like a 30 stock, equal weighted, rebalanced every quarter kind of portfolio, just picking out the cheapest stocks in the market above a certain market cap kind of threshold using the acquirer's multiple, which essentially is enterprise value to EBIT, I believe. And then we've got another ETF, ticker symbol DEEP, DEEP, which is essentially the same thing, but in the small and micro cap universe. So that's the plan. We're probably not going to pay too much attention to DEEP, I don't think, because there's like 100 holdings in that ETF. But we'll talk generally about how it kind of works. I've given a bit of an intro there. But I've got Toby Carlyle's book, The Acquirer's Multiple, with me here. So I'll maybe talk a little bit about some of the content in there and the actual returns that it's kind of at least back tested with. And then, yeah, we'll pick out some of the holdings in ZIG and do a bit of a ticker time, I guess, Frank style.
Awesome.
That's
I
the
just
plan.
want to say, anyone watching, if you've invested in ZIG or DEEP or any of Tobias's funds, let us know in the comments and how that's been going for you. Very curious about that.
Yeah, and Brad, you've you were running a little Magic Formula portfolio for a while, right? This is almost like a competitor to something like the Magic Formula, I think.
Yeah, it's very similar to the Magic Formula. And yeah, the Magic Formula did pretty well while I was doing it. I think I did it like a year and a half. But it's been a rough decade for, I think, both the Magic Formula and the acquirer's multiple. So
yeah, I think possibly even rougher for the acquirer's multiple, because Toby Carlyle basically looked at the Magic Formula, and which essentially is a similar strategy. It's trying to pick out the cheapest, best stocks in the market. So like best combination of return on capital and I think earnings yield from memory.
yeah.
Toby Carlyle's thought experiment was basically like, which one of these two is actually driving the returns, or is something magical happening when you combine them? And he discovered that basically when you ditch the return on capital, like business quality proxy metric, the returns actually got better, hence where the acquirer's fund kind of came from. So,
and I think I recall there's a little more volatility, but the returns are better. Is it? Yeah.
Yeah.
I think the other thing he also talks about it being a mean reverting factor. If something's a high return on invested capital, it attracts competition and theoretically reverts back to a lower return on invested capital, and vice versa. So I think being a mean reverting factor, he thought it would be better to remove it and just look at the value side of it.
Yep. Yeah. Maybe I'll just mention a few of the returns that Toby Carlyle wrote about in his book, The Acquirer's Multiple, which is actually a pretty good book if anyone hasn't read it. It's like you could knock this out in a day. It's like 150 pages of rather large font, so it's not too onerous of a read. But he's got a few different back tests or different market cap ranges in the appendix of this book, looking at how Magic Formula versus Acquirer's Multiple versus just the S&P 500 did in stocks with a market cap of $1 billion or greater, and 200 million or greater and that sort of thing. So I'll just pick out one, say the $1 billion and greater in market cap from 1973 to the first quarter of 2017 was the back test. S&P 500 did 10.2% compounded total return, so that includes dividends and things as well. Magic Formula did 16.2% compounded, and the acquirers multiple did 17.9% compounded, so a little bit extra for the acquirers multiple.
And what is the end date for that? When was the study done?
2017.
Okay.
Yeah. So there you go. What do you guys think? Should we dive into some of these holdings?
Yeah, sure. I guess the one other thing I'll add to it is it's almost exclusively a quantitative approach. It's diversified into 30 equal weight holdings, which you'll see as we pull them up in a second. But from what I've heard Toby talk about, there is a little bit of qualitative or stock selection that kind of goes into it. It kind of screens out the value, and then there is a bit of stock selection by him into there, which we'll talk about with a few of these holdings, I think.
Yeah. If you read the description of Zig now, and I think this has changed fairly recently, like in the last year or so, maybe, but it describes it as an actively managed fund now. And the other change is it actually used to be long short, so it would go long things with a very low acquirers multiple, but it would also short what Toby would describe as like hot air, basically. So like really expensive companies that didn't produce any cash, basically. But now it's long only. That's like a decision. It's like a risk mitigation decision I think Toby made. Just trying to avoid all possible ways in which the fund could blow up over a very, very long period of time. Like if you take a 40-year view, type thing. So.
Yeah. And it looks like the inception date, I think it's worth mentioning, May 2019. So this has only been going for a little over 3 years. Do you know if he had funds before that, or is this the first one of its kind?
I'm not sure.
Okay.
Yeah, don't know.
Yeah.
Okay. And yeah, like we said earlier, it's the anti-ARC. I might just share my screen here so people can see some of the recent returns. Both are down, but ARC is like a whole nother level of down relative to what Zig's up to.
Matt, he rebounds quarterly, I believe. Is that what you said, Tom?
I believe that's the case. Yeah.
Yeah.
Oh man, where is it? You guys seen that?
Yeah.
Mm-hmm.
So these are only 1 year returns. It's I won't go to 5 year because the funds haven't been around that long. But last year Round Hill Acquirers. I can't see the full name there, but there it is. That's the Deep Value Fund. Well, that's really laggy. Last year we're down 19.97%. Acquirers Fund or Zig down 18.7%, and ARC down 67.7%. Although ARC ripped miles ahead of these two deep value funds, a little bit before this.
And that would be, so even these two ETFs are down more than the S&P 500, is that right? Or pretty similar?
Good question, actually. Let's add that.
Yeah, it didn't give a direct comparison when I was looking at the data sheet.
Yeah, it looks like SPY is down 17.1%, so slightly less than the two deep value ones. Yeah. All right. Should we get into some of the holdings?
Let's do it.
Just share this again. We were just before we went live here, we were looking at the top 10 holdings, which we fairly quickly decided wasn't relevant because all 30 are more or less equal weighted. So I've downloaded a spreadsheet here just with all the holdings. Is that coming through?
Yeah.
Yeah.
Hopefully you can see that okay. So
might need to zoom a little bit more if you want, if you can.
Is that
Maybe
better?
you can look at the top 15 and then scroll down or something like that.
Yeah. So yeah, obviously when it's rebalanced, all of these are like that weighting, 3.33, but prices change and so on. But more or less equal weighted. I don't know. Should we just kind of pick out ones that look interesting, or maybe businesses we're somewhat familiar with?
Yeah, and I think it's worth noting Manu's comment as well, talking about the weighting. So if it's below 3.3%, it's down since they put it in the fund, I guess.
Yep.
And that will be rebalanced at the quarter. I don't know the exact dates that he does that, but if it's above 3.3, then it's performed or it's gone up since they've bought. So, yeah.
Cool. All right. Where do you guys want to start?
Well, the first one reminds me of something Terry Smith has talked about in his maybe recent podcast or something like that, about how toothpaste demand globally is just going to be kind of an easy bet that that's going to be going up as more and more people get access to toothpaste and kind of first world, dental hygiene is going to be more and more important. So
Got it.
that's one thing I think about with Colgate. Tailwinds, perhaps.
Yeah. Well, let's maybe start with valuation, because this is where the fund itself starts. So,
Yeah.
if we look at last 12 months EV EBIT, which is the acquirer's multiple, if I'm not mistaken, almost 20 times, which is kind of surprising to me to see a stock with that sort of multiple show up in this kind of ETF, which in theory is picking like the 30 lowest multiple stocks.
What's the
What do you
low
guys think
over
of
the
that?
last 12 months?
17.76.
Okay. Yeah, it's pretty high from what I've seen. The kind of multiples that Tobias looks for.
Yeah, I wonder if this is some of the like active management element coming in.
Right.
I don't know.
Yeah, I think it definitely is. It doesn't seem to really follow the approach that he at least markets towards the audience. But yeah.
Yeah, because I know he's talked about things like Domino's Pizza, I think, on some podcasts as well. I'm pretty sure that's in here and certainly isn't trading at like 3 times EBIT or something. All right, let's have a look at some of the financials, I guess. Should we give it the ARC test? How's revenue grown versus the share count? Change in revenue. Okay, let's just call it single digit, maybe a little more than flat revenue growth. And shares outstanding going down. You love to see it. That really is the anti-ARC. But revenue, gross profit. Let's grab maybe net income.
And buybacks is definitely something that Tobias Carlyle talks about a lot as well. It is a factor that he considers. So I think in a lot of these companies, we'll see that the capital allocation decision to going towards buyback of shares, which when a company is cheap, theoretically is a good decision to do. So I'd be surprised if there's any companies that are diluting shares in the portfolio.
So it could be a good place to look for cannibals as well, kind of a shortcut.
Yeah, for sure. General thoughts on this particular graph?
How many years is that?
This is back to 2007.
Okay. Wow.
It's basically gone nowhere, hasn't it?
Yeah.
So looking at the share at the price chart, I guess, since that same time period, it's been about 6% compounded return with an extra about 2% dividend yield as well. So although revenue's kind of gone nowhere, the returns have been reasonable, I guess.
Yeah, that's just the net income chart, so pretty flat. Wonder what earnings per share has done, whether that's grown a little faster, just given the buybacks. Maybe a little
Slightly,
more.
but yeah.
Yeah. Interesting. Okay. Anything else you want to look at for this one, or should we pick out the next stock?
No, nothing really. I think it's a fairly lackluster start to the portfolio.
I think we're going to see a lot of that, to be honest.
What does return on equity look like for Colgate?
Sure. Whoa. Okay, let's ignore 2016 because something weird happened there.
Even if you just scroll down to the numbers.
Yeah, okay. Good Lord. What's going on there?
So even returns on capital over that period, it's consistently around the 40-50% range, which is impressive, I guess.
Yeah, I wonder if something weird must be going on with book value for that return on equity to be so high. Maybe that's another buyback thing. But yeah, good business, just not growing. That's the trouble. Like, this is the whole Kraft Heinz dilemma that Buffett had. You know, like it earns a very high return on, I think, tangible capital or tangible assets is how Buffett would describe it. But they've got no way really of deploying more capital at those rates, and it really has to earn on your purchase price as opposed to the capital that's in the business. It's kind of another one of those. Okay, where should we go next? Any companies in here you guys are familiar with? Obviously, we all know Meta. We've probably talked about that enough. Should we maybe do Domino's Pizza?
Yeah, pull Domino's up.
Okay.
Worth noting, there's a lot of pharmaceuticals kind of appearing in there, just from reading through the names at least, which kind of happens when you're running these type of screens.
Yeah. So there's a few Domino's around the world, but that's going to be the US one, presumably, DPZ.
Mm-hmm.
Now, this one's going to look a bit more interesting in terms of growth. I know that right off the bat.
Yes.
Because this has been like one of the best performing stocks of the past 10 or 15 years, if I'm not mistaken, right?
Mm-hmm.
So revenue's gone from 1.4 billion to 4.3 billion. So about a triple ballpark. But net income has gone from 37 million to 510 million. So like a 10 or 15x. That's pretty impressive. So I guess the margins must have expanded pretty nicely. Yeah, that's pretty impressive. To go from 2.5% net income margin up to like 12, and pretty steadily trucking upwards as well.
Yeah.
Yeah, this is the fairly stereotypical compounder rolling out of stores. Yeah, the return over 17 or 18 years, or 17.6 years, is 18.5% annually. And that's with a pretty significant pullback recently from about $540 per share down to what it is now at $330. So before that pullback, the returns were close to 25%, maybe more, I think. And maybe that's what attracted Toby in the first place. Do you want to pull up the EV to EBIT or whatever multiple historically, just to see if they're cheap relative to what they have been in the past? So not really, surprisingly.
Yeah.
It's kind of always
pretty crazy. Pretty crazy that you could have bought it in single digits back in the financial crisis, and then it went on to grow like it did as well. But yeah, I guess the max ever is 31.85, and it's 22 now. So it's chopped a third of its multiple off, roughly. Is this something you guys would be interested in? Something like Domino's Pizza, or not cheap enough? Or too large, Frank?
Well, if I wouldn't mind investing in a company this large if it was extremely cheap, but it doesn't appear to be extremely cheap. Now, that could prove to be wrong 5-10 years into the future, but from what I'm seeing, no. For a company to be this big, I'd need to see it extremely cheap.
Yeah.
What's the market cap now? 20? No, not 20.
11.5 billion.
Okay. Might have been 20 a few months ago.
Yeah. Let's give it the ARC test again. We know revenue's growing. Yeah, buying back shares as well. That is going to be a recurring theme, I think. They bought back aggressively, like 10% in 2017. And still 3 to 5% in recent years.
Which
That's
is
pretty
something
serious.
I think they'll continue to do moving forward as well.
Yeah. Okay, cool.
Yeah,
What next?
Manu has some comments. Typically only one employee per store. That's nuts. That's really going to help the profits.
Yeah, Domino's is a great business, like the whole model of it. They even kind of were very disruptive with their technology. They haven't gone towards the Uber Eats. They kind of internalized their own technological background kind of thing to do their own delivery and everything else. So it's an impressive business in almost every way. Yeah, price is the main thing that doesn't appeal to me, but obviously Tobias Carlyle's the king of deep value and he thinks it's cheap, so who knows?
What's cheap enough for you, Frank?
It's hard to say. Every business is different, obviously, but this doesn't scream out to be cheap. Besides the pullback in share price, which take of that as you will, it doesn't seem to be overly cheap. Anything over, say, 15 times earnings isn't something I would automatically put into the value basket, I guess, which is just like the market average multiple over a long period. So it doesn't fall into that range, but then that's not considering margins of growth or anything else as well. So that's just one factor.
Mm-hmm. So are you telling me you like Zoom from the ARC episode we did over Domino's or what?
I would take Domino's happily over Zoom any day, but
Okay.
And with a company like this, I'm sure it performs well. It's just how well it performs. I could see a very market average 8 to 10% return being very achievable for a company like this at this valuation, but it's just not the type of return I'm looking for.
Yeah, and Matt makes a really good point here. Like, if the incremental returns on capital are these numbers, like 70%, and they've got a lot of room to keep deploying it, I guess you can pay higher multiples for sure. Yeah, I'd certainly rather own something like Domino's that can keep opening stores as opposed to like a Colgate if the multiples were similar. I'll put it that way. Yeah. All right. Where do we go from here, guys?
And I guess just final thing to add, if you're running a diversified portfolio of 30 stocks, Domino's is the type of company that I think I'd be interested in, which is what this fund is. So it kind of suits the portfolio, I guess, but just not my personal strategy.
Fair.
O'Reilly is that? Who's that? Who's that guy that you saw in Omaha, Tom, walking down the street?
That guy is still walking down the street.
Yeah.
I don't know, Brad.
Big investor. Come on, big value investor. Chuck Akre. I think Chuck might be bullish on O'Reilly. I don't remember if that's in his portfolio. But.
Do you know much about the actual operations of O'Reilly?
I don't.
I've never heard of them personally.
Yeah, I'm just pulling it up now. I've never come across them.
Auto parts retailer.
Sounds like something that's maybe just American.
So over 10 years, they've had a 23.7 annual return. So it's been a fairly typical compounder.
Uh-huh.
Nearly a $50 billion company.
Yeah, auto parts in the US. Okay.
Yeah.
So is this similar to what something like Copart is doing, or?
No, it's very different. Copart buys basically junk cars from insurance companies like Geico for very cheap, and then they resell them to fixer-uppers and things like that, and sell them for scrap.
We found a cannibal, guys.
Where?
Right here on the screen.
O'Reilly. That's a thing of beauty right there.
That is 141 million shares outstanding, down to 69 million.
Oh my goodness. Cut in more than half.
Yeah, that's pretty serious.
Yeah.
And they're still buying back like over 5% a year, and around 5% a year the past couple of years, as well as growing revenue like, I don't know, call that high single digits on average.
Yeah, O'Reilly is Chuck Acre's 5th largest holding. So,
Dang.
And there's just been some fairly steady operating leverage taking place over the course of 15 odd years, where it's just all the margins are just slowly growing while the share count's slowly diluting. This is like the type of company you want to find early. I don't know how long they can continue this for without understanding the business model. Again, never really hearing of this company at all.
Yeah.
But that's exactly
like-
what you'd like to see in the historical chart, I guess.
It's like NVR type stuff. It's like growing and buying back for a long time.
yeah.
All right, let's see what the valuation looks like.
Can't be cheap after all that, can it?
Again, Tobias is disappointing us with these valuations.
Yeah, I want to see a 2 or something. None of the 17.
I'd sell for an 8.
If we pull up some of the pharmaceuticals, maybe we start to see some of these really low multiples. But
Yeah.
the 3 so far are kind of these higher quality, steady growth kind of companies. More of the compounder at a fair price.
It's pretty crazy that like the multiple, I mean, it's maybe expanded a little over time. I guess depends on where you bought it, but it's been reasonably flat, really. And you just got all your return from the business growth, basically.
And
Yeah.
buybacks, yeah.
Okay. Any final comments on O'Reilly?
O'Reilly. They got a jingle that just sticks.
Can we hear that again?
No.
Belt
I'm trying to get it out.
All right. What else we got?
So far we're seeing very high quality companies. Let's see some of the value now.
Yeah. What's got something on here's got to look horrific. Best Buy.
What do you like for value? Oh, Best Buy's got to be.
Best Buy's got to be single digits, right?
Sure. Pull it up.
Yes. Dying retailer.
We'd love to see it. Give it 5 or 10 years and we'll get another Seritage out of this thing.
That's it.
All right. Oh, yeah. Let's start with valuation.
Yeah, get to the good
It's
stuff.
growing, though. Ah, yes. We're in single digit territory now.
All right.
7.8.
Okay. There it is. 8.
Nice.
What
We're getting
looking
better.
for.
And now, is this another one buying back shares? I would assume it is.
I think Burry liked Best Buy maybe a few quarters ago. I saw it on his 13F. Yeah.
Another cannibal.
I like it. And let's do earnings per share. Nice. The last
What are those years
5
where it
years look
was-
amazing. It's just if you cut off the years before that, it'd look really good.
What was the time period where it's kind of negative there? Or
2013.
what was happening then? Is that
Let's just grab some of the basics.
Brad? What is Best Buy, by the way? Retailer,
so-
but what are they? What's it look like?
You go in and there's music like CDs, there's computers,
So like an electronics
appliances.
type of
yeah,
thing?
electronics. Yeah, electronics appliances.
Right. I'm just trying to think of the equivalent here in Australia. Maybe like a Good Guys, if there's any Australians in here that can help me out with that one.
After dinner investor insider buying happening at Best Buy. We got to be respectful of Best Buy. That's going to be tough.
Be respectful. Luis isn't. Yeah. Best Buy screams potential future shares, but I'd be wrong.
Yeah, that's the camp I'm in.
Yeah. Okay.
Could you pull up the cash flow statement on this one?
Sure.
I'm assuming it's a fairly capital-intensive business. I'm just curious what they do with their cash flow. So a down year for, what's that, a change in inventories, is it? Or accounts payable?
Which year are you looking at?
The most recent last 12 months, their cash flow's down pretty hard from a change in accounts payable.
Yeah.
But yeah, typically they've made some acquisitions, spend most of it repurchasing stock, and then a dividend as well.
Yeah. Interesting. I wonder what happened. Like, how do you suddenly get to 2018 and become a whole lot more stable? I assume they got a bit of a COVID bump there in 2021, but no, they seem to be a bit more all over the place until the last few years.
Oh, maybe they actually got onto a good strategy, right? They kind of
And I guess just scale advantages and things like that. You reach a certain size where everything becomes a lot more profitable, or operations work better.
They ditched what wasn't working. Who knows?
What do margins look like? Is it stable margins or improving? Because that's the other theme I guess we've kind of seen is operating leverage with buybacks kind of taking place. So very low margin, pretty steady. Yeah, okay.
Yeah. Well, actually, that might be throwing it out.
Besides that, whatever happened.
It's trucked up a little bit. Like going from 3 to 5 is pretty material, obviously.
Yeah, and I looked it up.
Dinner investor as a fan, by the looks of it.
Okay. I looked it up on Data Roma. There's virtually no super investor interest in Best Buy right now. Wow. Okay. Jason goes into Best Buy still. That's interesting.
What does that make you think of, Jason?
We'll talk offline.
Okay. All good. Right, let's do another one. Also, if there's any stocks actually on this list that you guys want us to talk about, pop it in the comments. I see someone's brought us to the painful place and mentioned GraphTech before already. But if there's anything else you want to look at, let us know. Should we maybe do... actually, I was going to say HP because that's a recent Buffett stock.
Buffett buy.
Yeah, I wonder if we maybe do Oracle first. I recall looking at Oracle 2 or 3 years back, maybe. They always kind of look cheapish and like the financials look healthy. So I'd be interested to take another look at that one. Have you guys ever looked at Oracle?
Okay.
No. What does Oracle do?
What is it?
It's
Enterprise
like
software.
Yeah, it's like a software business. Enterprise IT environments worldwide. Oracle Cloud Software. Yeah. Something I'd need to look more at.
So pretty steady over the past 10 years, yeah.
Yeah. Okay.
A lot of kind of just mature businesses here. I guess this one's buying back shares as well.
Yep.
Mm-hmm.
Pretty aggressive. What's that? 5 billion? Is that shares outstanding? Down to 2.8.
Pretty
Almost
much
bought back half the stock in the last decade or so.
It's the smartest thing they can do with it, I'm pretty sure.
Yeah, multiples leapt up a little bit recently, but maybe mid-teens. Was lower a couple of years back. This is really a bit of a repeat of the ARC episode, isn't it? When like every stock's
really
just
is.
the same. They're a very different type of the same, but they're the same.
Mm-hmm.
All right, let's move on. I think we had a couple of comments before around what people wanted to look at.
And any other questions, I guess, drop them in now, and we'll try to get through as many, whether it's related to Zig or not.
Yeah, whether you want to know what kind of beard oil Frank uses, anything, just pop it in there. All right.
That's going to take a
any-
super chat, though, for him to reveal
okay.
that.
Yeah. Okay. Yeah, it's top secret information.
Mm-hmm.
Right. Where do we want to go next? Luis says, wonder if Tesla will ever be in this ETF. No comment.
If it goes
Is
long
it-
enough, you know.
Is this something you guys would ever consider owning? Is there any world where you would buy an ETF like this?
I think if I, for whatever reason, just got bored with kind of researching stuff myself, maybe it would be that type of world where I'd maybe look at something like this. That's probably about it, to be honest. What about you guys?
Yeah, you know, that 89 point, what is it? The expense ratio, that turns me off a bit, to be honest. I'd be more inclined to just own an index fund like the S&P for 4 basis points.
Would you be tempted to recreate it yourself from using a screen or something?
I would.
Yeah, okay. All right. Actually, I think this one here is very likely to be single digit. I'm not sure if you guys have ever looked at that.
Oh, yeah, for sure.
But is there anywhere else you want to go first?
Let's take a look at that one.
Okay.
Poor U.S. Steel.
In contention for the best stock ticker on the planet, I reckon. X. It's just clean.
X.
Let's do the financials because this is going to be wild. This is just basically like a super cyclical commodity business, really, isn't it?
Mm-hmm.
Okay.
Oh, God.
Oof.
Oh, God.
I have whiplash just looking at that.
This is how you get to become a PE of 1 or something. You do this type of thing. So their 2 best years in history, net income of, I guess that's 2 billion. And they just did 4 billion. And man, all over the place outside of that.
So maybe it's not cheap.
Value trap, textbook.
Mm-hmm.
This is how GraphTech got in there as well. Yeah, like they've had years where they've lost 1.6 billion, which is kind of crazy.
What's the multiple on this one?
Let's just check the share count. Maybe we'd better do that test. Oh God.
Oh boy.
The opposite.
Interesting. This is the first diluter we've looked at, isn't it?
Yeah.
That's a big dilution to happen in a single year. 196 up to 280. Did they make an acquisition or something?
Yeah, can you pull up the cash flow statement?
Where do you want to go?
Even just have a look there. It's just to see what they've done with that cash from dilution. Most of their cash seems to go towards repaying debt. A couple of buybacks recently. A lot more in the last 12 months than ever before.
Seen a bit of a jump in capex.
What's the market cap on this?
$4.6 billion.
And they
didn't we say they just made $4 billion in a year? Okay,
let's pull up the valuation it is. And yeah, they've just bought back over 10% of their shares over the past 12 months as well.
Okay.
What's the multiple?
Weird. 1.
EV to EBIT of 1. Cool.
Wow.
That's insane.
Yeah, so I guess this is just a bet on what they do with the cash that they have available right now. If you had a clear understanding of what the capital allocation decisions kind of were, I could see why this is appealing. Not as a long-term investment. This would be more short-term orientated, I'd guess. But it's hard to go wrong with something so cheap, I guess. The downside protection would seem to be
but like
there.
if their earnings goes down 90% or something, they're not that cheap. And that might be getting back to normal.
If they buy back 90% of their shares at the same time, it doesn't really matter.
Yeah, you just stand still, don't you, if that all happens? Is that how the maths works?
Yeah, so, I don't know. Anything this cheap can make sense if you understand it well enough, I guess, but...
Yeah,
management may not be too incentivized to be buying back shares based on their history.
Well, they've just bought back 600 million, so that's a good start.
Didn't they dilute? Was I seeing that incorrectly?
Over the last 12 months, though.
Oh.
Yeah, we didn't quite have the latest year in there.
And maybe there's some kind of special dividend they might pay out, or that could be scheduled or something. So there could be appeal just from the payout.
Yeah, I wonder if they've... Jesus. 8 cents a share? That's like nothing.
Have they paid any special dividends in the past? If you scroll down to the line below that. They don't have it there.
Yeah, there'd usually be another row saying special dividends per share or something.
I think so, yeah. I don't know, maybe that's something that's on the cards. They're a cash-rich company at the moment, I guess. So it'd be interesting to see what they do with their sudden inflow of cash.
Would you guys ever buy something like this?
Not this specifically, but I would like something in this scenario, something trading this cheap. But it would have to be a business I could understand, maybe not commodity related.
Yeah. Yeah, and I think you have to understand where the capital's been allocated.
Yeah, for sure.
Yeah, that's going to be pretty material. Okay, cool. Should we do maybe one more and then take some questions?
Yeah, sure.
Sound good?
A lot of comments about IAC. I think every week we kind of get comments about that, so maybe that's a future episode we could tackle.
Okay. That's not one that's in the portfolio here?
I don't think so.
Okay.
Yum Brands, did we want to look at that?
I was about to say the same thing. Is that Kentucky Fried Chicken, KFC?
Yeah, isn't that like KFC, Burger King, Taco Bell?
It's a number of fast food restaurants kind of rolled into one company.
Yeah. I think there's a Yum Brands Australia as well, right?
Yeah, there is.
Separate company? Same thing.
I'm sure there's one listed on the ASX. I'll have a look.
Give us the overview. Let's see what they own, if it tells us.
KFC, Taco Bell, Pizza Hut, and the Habit Burger Grill. I've never heard of that one.
Okay.
Was Burger King a spin-off? Maybe. I recall Yum Brands used to have something to do with Burger King, but maybe they don't have that anymore.
Yeah, I'm not sure.
Okay. Did you
There
track
is a
anything
Yum.
down? Oh yeah.
There is a Yum Brands in Australia with 140 something stores, but it's a subsidiary of this company.
Okay. Gotcha.
I'm sure it was once listed, but I can't find it, so maybe not.
Yeah. I actually
doubt-
met a previous Yum Brands director who I'm pretty sure was doing work in Australia. So I'm fairly confident that there was something. But maybe not.
Yeah. I did a university assignment on Yum Brands Australia where we had to make a new marketing campaign for Yum Brands specifically.
Right.
So I did KFC selling alcohol. That was my pitch.
What kind of alcohol would a KFC sell?
Beer. Good old Australian beer.
Okay. But a Great Northern or something?
VB was what I was at. What I had in
VB.
my little logo that I made as a 19-year-old.
Yeah, okay, nice.
I had the Colonel with a VB, the VB logo on him. So
Classic.
not sure how well that really goes down, but that was the pitch at 19. So
I'm going to take a wild guess that Burger King got spun off in 2013 here.
yeah, that would make sense.
Yeah, if anyone actually knows that, let me know. I can't find it on Google. Looks like they possibly used to have Wendy's as well.
Right.
Interesting. Okay. Anyhow, let's maybe look at a few more recent years so we don't have that whatever happened in 2013 in there. But yeah, pretty flat, maybe even slightly declining,
Yeah.
at least on the top line. Bottom
So it
line
looks like-
maybe expanded a little.
It looks like Restaurant Brands International owns Burger King,
Okay, maybe I'm
which
getting them
is
confused.
similar to Yum Brands, kind of a conglomerate fast food.
Okay. So, financials are pretty flat. What's the... I think we're starting to see a pattern here, gents. 453 million outstanding down to 302 over the past, what's that, 7 years?
Pretty
Nice.
solid.
What's the multiple?
Can't be low, I don't think.
Weird. This is surprising to me that there's some of these, like something with a 2 in front of it, and there's been a few of them in here, or at least getting close to it.
Yeah, I guess it makes sense as a stock picker more so than a quantitative approach that he kind of says that he's following. Because obviously 20 times earnings can be cheap compared to 5 times earnings, depending on the growth and everything else. But he seems to talk about more of this quantitative approach where you ignore some of these factors, but it doesn't seem that he's actually ignoring them, which is a big surprise to me.
Yeah, it's interesting. Okay, any final thoughts on Yum Brands, or should we take a few questions here?
Let's get questions.
Well, you mentioned, Frank, you mentioned that he's kind of overlaying some qualitative factors in his selection process. Did you know more about that? I mean, that might speak to this that we're seeing.
That's kind of just what I've heard him talk about in certain podcasts here and there when he's pitched both Facebook and Domino's. But I didn't think it was kind of a recurring theme across the whole portfolio, but we put up 7 or so names and it was pretty reoccurring. So obviously there's a lot more stock selection going into it, which is probably a good idea, because if it was just a low multiple screener, then there'd be no need to pay the fee. You would just do it yourself.
Right.
But yeah, I don't know. No
Yeah.
real pro or
I
con to
think,
that.
yeah, people will pay for convenience to an extent, but yeah. I think he's probably screening on EV/EBIT, but then likes to see buybacks. Probably a handful of other things. All right, get your questions in there, everyone. Any in there that you guys want to have a crack at first? I can't recall what I said here, but Jason's talking about his waistline for some reason.
Let's tackle that question under that. It wasn't to us, but I want to hear your thoughts. Top 3 fast food places. I guess all our answers are going to be different just because of where we live.
Chipotle.
Australia.
If you consider Chipotle fast food.
Yeah, sure. 2 more, Brad. You're the American. You're going to be right on top of this. You've got the options compared to me and Tom.
I don't really do fast food. I'm watching my waistline like Jason. So, you guys have any?
I think the ones that I frequent most would be like Domino's and McDonald's, probably.
Yeah, mine would be most frequent. Doesn't mean that the best would be McDonald's, KFC, Domino's.
Yeah.
Okay.
And in Australia, there's not too much beyond that. I like the I guess it's the Chipotle equivalent, similar to Sombreros here in Australia, which is just make your own burrito type thing. Whether you call that fast food, I guess, but that's probably my favorite as of the taste of the food. But it's too easy to go through a drive-through McDonald's in Australia. I think you can't go 5 minutes without seeing one, no matter where you live.
Yeah.
Pretty much. All right. What else we got? It's a good one from Louise. What's one mistake you feel you keep making when investing? Any takers?
Are you implying, Luis, that we don't learn from our mistakes?
I've made plenty of mistakes. I'm trying to think of something that I feel like I've made multiple times. I don't know.
Do you reckon you ever ignore stuff that's not a micro cap just because you want to focus on micro caps? Has that ever been a mistake, or there's nothing that you've really that's been a home run that you've passed on?
Well, I guess some of the best returns could come from a large cap. I guess focusing on micro caps is just part of my strategy, but no, I don't think that's a consistent mistake to make. That's just part of my approach.
Mm-hmm.
Yeah.
I'm sure if you focus just on large caps, then you'll miss the opportunities of some of the micro caps too. So that goes both ways.
For sure. Brad?
I'm going to have to sleep on that one, I think.
Brad doesn't make mistakes, guys.
No. Well, I do, and then I fix them.
Then you make a new one. You keep discovering new ways of making them.
That's it. Yeah.
I don't know whether this is a mistake, but something that I see consistent in my portfolio is that I might have focused more on quality than I have on value. I would like to see a kind of lower PE overall for my portfolio. And it doesn't seem to be the case. So maybe I've paid up in some situations, or some of that is from multiples running up, like Kelly Partners, for example, was cheap, isn't cheap now. So there's a bit of that in there, but I think over the past few years, I've probably paid up more than I would want to without realizing I was doing it at the time, I guess. So that might be a mistake.
Yep. Nice.
How about you, Tom?
Yeah,
You've
I
got all
think I
this time
probably
to
have
think.
like a bit of I think it's authority bias. Is that what it's called when you put a lot of weight in someone you respect buying a particular stock? Yeah, I think I've experienced that a fair bit over time. Like it has probably influenced my thinking when I'm researching a company more than it maybe should have. That's one I think I make pretty frequently, to be honest. Yeah, but yeah, and that's one I should add to my checklist or something. But I've tried to implement like an investing checklist to try and minimize some of the really dumb errors. But there's those like overarching biases that you sometimes forget about can sort of creep in, I guess.
Cool.
There's another good one there for Luis, if you want to pull that up.
That one?
Yeah.
To be nice, I'm also curious if you... where's it going? To be nice, I'm also curious if you feel there is a trait that gives you a huge advantage over others, something most struggle with, but you've never had any issue with when investing.
Hmm.
Do you want to have one guess at what my answer is?
An exceptional armbar. I don't know.
Over time, more and more, I still think the biggest competitive edge as an investor I have is investing in liquid companies, typically
Illiquid.
small and micro.
But that's not like a
cap
personal
companies.
trait, though. Isn't that what this question's about?
Well, personal trait, maybe I missed that. That's kind of the advantage, at least I think I have. Maybe the personal trait is that I'm willing to and comfortable to accept the volatility in those illiquid companies.
Nice.
And to be fair, they're not a liquid for me. Like I'm not investing too much money relative to a fund. So I can get in and out of these stocks, whereas most large investors can't. And I think, I don't know, I'm competing against a couple of hundred investors while most people are competing against thousands and thousands of investors.
I like it. Brad?
Yeah, I would say patience, the ability to just sit and do nothing, like Guy Spear.
Yeah, I was going to say the same thing. There's some things that I get annoyed if, they don't happen quickly or whatever. But for the most part, I'm probably in too patient of a person, so that helps with that helps for sure. Yeah, like we've talked about specific stocks on here before, and it's always surprises me how much people can get far more positive or far more negative on that particular stock, like 6 months after making the investment or something. when we all talk about being long-term investors, so that's patience is definitely a good one.
How often do you guys check your portfolios? I'm curious.
Every day, but it doesn't impact. It doesn't impact like actions. Like the actual number of transactions in my portfolio is minuscule, but I'm looking at it all the time just out of interest, really.
Out of interest.
Yeah.
I think I looked at my portfolio for the first time today in at least a month.
Really?
Yeah, over time I've started to check it less and less. It's usually when I'm buying that I kind of look at maybe how I can rebalance or move money around in the portfolio. But overall, I think I check it not very often at all. So I think that's probably a good thing, at least when you're thinking around the patience advantage that we might have. But yeah.
Yeah. How about you, Brad?
Well, I just moved, and going through that home buying process and moving across the country, it's been very easy to not check. So it's maybe been 3 months since I've looked.
Wow. Jeez.
It feels really good.
Yeah.
Well, I hadn't checked mine in a while, but I was actually up for the year, 4 or 5% last time I had looked, which I was pretty happy with. And sadly today I found out I'm down 1% year to date. So hopefully if I ignore it for another month, I might be back up. We'll see.
Yeah, as a lot of that exchange rate, we were talking about this in the chat a bit yesterday, but I it depends what way you look at it, I guess. But US stocks look a lot more expensive all of a sudden to me now just because of exchange rate. But yeah, US dollars like going to the moon.
I'll actually check that because I didn't pay too much attention to the currency.
Yeah, like because I'm probably in a similar place year to date, but a lot of it's been currency gains from the US dollar.
What was your year-to-date
it's
currency gain or loss?
It's double digits. I don't know off the top of my head.
So 2.47% currency gain year-to-date.
Yeah, well, okay, so the Australian dollar's been ripping upwards pretty nicely too. It's just
And I've
the
got-
Lord New Zealand.
I've got pretty random, like I've got a lot of different markets and currencies in there, I guess.
Yep.
A few
Nice.
Great Britain pounds in there.
Yeah. Yeah, it's interesting. Like the whole patience thing, like I say, have very few transactions, but I'm paying attention to stuff all the time. Like yesterday I watched like a 20-minute interview with the CEO of Airstream, as like a little scuttlebutt update on thought sort of stuff. I'm doing that type of thing all the time, but I guess I'm not that active in trading or whatever.
Yeah, you're playing the long game. I see Cane's as a fast food place. I've never heard of that. Do you guys know what that is? Cane's?
Isn't that like a chicken place? I think it's a US thing, but I've heard Jason talk about it on the podcast, on this podcast a couple of times. We've also got a super chat from Luis, which has been sitting there for a few minutes. So
Oh, let's talk about that.
rocket into the moon.
Luis, thank you.
Any thoughts on that, on those emojis?
Rocket to the moon. Boy, it's hard to see that happening anytime soon.
And in what respect? Like literal rockets, or what are we talking about?
Like the days when each day you check your account, you're, up again.
Yeah.
Feels like we're in a different time.
Yeah. Right. Any other questions you wanna tackle there?
After dinner asks one to you, Tom. Tempted to pay down your mortgage fast or still buying stocks?
Oh.
Yeah, I made a video about this the other day, although I feel like in that video, and I actually got a few comments like this, I feel like in that video I just kind of talked in circles for 10 minutes, really. But yeah, it's interesting. Like part of my mortgage is in a revolving credit facility, which basically means I can throw money at it at any time, but I can pull that money back out at any time, which has added a lot of flexibility. It's really nice to be able to do that as opposed to having cash sit in a savings account earning 0%. I now have more assets and have taken on debt to do that, but I can effectively earn like a guaranteed, my interest rate percentage return. So yeah, we had, without giving away the exact numbers, we had a decent like chunk of cash over and above what we needed for a house deposit sitting there. So that kind of immediately got thrown at that revolving credit facility and paid down a pretty big chunk of it actually, which is nice. But it gives me the flexibility to pull that back out for stock purchases if I need to. So yeah, I'm probably somewhere in the middle. Like I don't see myself tapping that facility right out and being super heavily indebted. But I'll be willing to do it if something comes up. So I don't know if that really answers the question, but yeah, I'm willing to put money towards stocks as opposed to pay off mortgage debt faster.
It doesn't bother you to have the debt sitting there?
Not really. As long as as long as I've got some comfort, like a bit of breathing room between my monthly income and whatever the debt servicing costs are. Yeah, I'm comfortable with that. Yeah, I don't know. You've just been through the home buying process, Brad. Do you want to cover that at all? Or did you just rock up with a briefcase full of cash for that thing? I know you've made videos on that before.
You know, I got to practice what I preach, Tom.
Okay, fair enough.
No, we'll probably do that in a different episode. You know, Jack
Okay.
having bought something recently, and I think that can have its own thing. But
Yeah.
Matt Hansen, Punch Card Conference Fund. We got another super chat. So thank you, Matt. Appreciate it.
Thank you very much, Matt.
There's a question from Matt H. Do you think?
Yeah, that was interesting.
I lost it now. Something about yields. Yeah, bonds. Is bonds something you would consider if we had higher yields like we did once upon a time? Maybe soon again?
Yeah, it's tough to not get interested in 15% yield on bonds from my perspective.
Yeah. It's interesting. I know Buffett has talked about saying that he should have bought more bonds when they were paying that should have bought more long-term bonds when they were paying those rates back in the day. But at the same time, he was like, you could buy pretty good quality companies, probably like things we've been looking at today at like 4 times earnings as well. So
Right.
That's also out there. You can get 25% earnings yields that are growing in that type of environment potentially as well. So it really depends on the entire opportunity set as opposed to what the bonds are doing. But
Yeah, I think the only thing it would change for me if there was some kind of safe long-term bond paying 10, 15% or whatever, would just affect how much money I would have fully invested. Like I'm pretty much always 100% invested into stocks at the moment. But maybe I'd be more happy to sit some cash in bonds and wait on the sidelines if the yield was high enough. That's probably the only thing I think it would change for me. But overall, I wouldn't be moving significant amounts of money towards bonds. I'd still be looking for cheap equities.
Yeah, and in a world where bonds are 15%, like inflation's probably humming along as well. So, yeah, like if inflation's 12 or something, maybe it's not really that interesting. But when inflation goes away and then rates go to zero, like the face value of your bond's going to go to the moon. So that could work too.
Art of Value. I'm in Asheville, North Carolina. Good to see you.
It's always good to
channel
see.
For a while. Mm-hmm.
Yeah, it's always good to see Kiwis in the chat. I know the Art of Value is a New Zealander. So.
There you go.
Yeah.
Super chat.
Eunice
Last
with
one.
the super chat. Yeah, sure. How concentrated are your positions?
I'm just pulling up my portfolio now. Do you want me to go first, or you guys do you know yours off the top of your head?
You go first if you got it there.
So my biggest position is in one microcap. That's 40% or 39.14% of the portfolio. Then I have another one at 16%, and then a handful kind of sit in the range of, say, 5 to 10%, and 3% in cash. So mostly concentrated into one position, and then relatively equal weighted for the rest of them. That moves around a lot, but yeah.
Is most of your net worth in stocks, Frank, or like is that?
Yeah, almost.
Oh, you don't have to say if you don't want, but
no, that's fine. Almost all of it is in stocks. I have cash that I don't consider into my investment portfolio. That's kind of saving up for a house deposit. So I say I have roughly, say, 3% cash at the moment. That moves around a little bit. But really, I probably have more like 20% cash. It's just cash that will never be in my stock portfolio, and that will just go towards a house eventually. So,
yeah. What about the Lambo, Frank? Is that in there?
I have no.
That's a 0.5% position, Brad. So we don't talk about it here.
Sorry.
No, I have no serious debt. So, a car loan, a partner's car loan, but that's relatively paid off anyway, so most of it's just equities and a bit of cash.
Yep.
Cool.
Brad?
Tom, you got yours in front of you?
I can speak to it off the top of my head. So a couple of things have changed here recently because I like to think about it in percentage of net worth terms. So we've just bought a house. So we had cash aside for that, but that's now converted to home equity, I guess, and we've got net debt. But if you look at sort of home equity versus some of the other stock positions, that's kind of how I think about it. And I've also just combined finances with my partner. So I guess that like we were in a similar position overall. So that kind of cuts our combined allocations in half, if that makes any sense. But even then, I think the biggest individual stock is probably like 10% of our combined net worths, something like that.
She's not a stock investor as well, Tom?
Yep, she had one position. Can you guess what it is?
Apple.
She had one stock. No.
Berkshire.
Yeah, it rhymes with Berkshire Hathaway.
Yeah. Oh, wow. So, you chose well.
Yeah. So that's where I'm at. I think over time I'd like to get more heavily weighted towards stocks. Obviously, it's just kind of where I like to operate, but that's where we're at.
Oh, I wanted to ask Frank real quick. What was your cost basis as a percentage, I guess, for that top holding? Because it's run up quite a bit, right? Was it like a 20% bet when you made it?
Well, relative to the size of my portfolio now, it would have been like a 15-ish%. But at the time, I was moving from I was invested in mostly ETFs before switching to a more stock picking style approach. Right. So it was pretty much the same as it is now, but relative to where the rest of the positions, as I added them in, it was about a 15% position.
Okay. Cool.
Yep.
I think my top is about 30%, but it's because it's run up a bit. It was around 20% when I bought. So
nice. Mm-hmm. Cool. You guys want to take any more questions, or should we wrap it up there?
It's getting late here in Asheville, so
that's right.
You can't run that anymore.
Change, haven't you? How much later are you now for this stream?
It's almost midnight now.
Yeah, okay. That's right. We better let you go. All good. Well, thanks everyone for joining us. This was fun. As always, if you got topic suggestions and things, let us know in the comments, either if you have a few seconds now in this live chat, or if you want to comment on the replay, those are always useful. And I'm now going to try and figure out how to do this outro, because that's kind of complicated. But I think I've got it. We'll see you guys next week. Thanks for watching.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.